I'm Professor Indra Bissekra. Get to look at accounting for the effect of taxation, part 2. Relevant accounting standards are AASB 112 and the corresponding International Accounting Standard 12. There are three aspects we are going to look at: temporary tax differences arising from revaluation, temporary tax differences arising from tax losses, temporary tax differences arising from income tax rate changes. We have learned so far about temporary tax differences when the carrying value of asset is greater than tax base, or the carrying value of liability less than the tax base. It will result in more future cash inflows for the company or more future cash savings for the company. That will result in taxable difference, and the tax component of that becomes deferred tax liability. We credit deferred tax liability and we debit income tax expense. In this instance, the difference is 300 taxable difference. 30% as tax rate gives us deferred tax liability of 120 and income tax expense of 120. So similarly, if the carrying value is less of an asset than tax base and liability is more, carrying value of the liability is more than the tax base, that difference will result in less future cash inflows for the company, and therefore more tax that's being paid becomes a saving. More tax that's paid now becomes a saving, and that difference between the tax base and the carrying value becomes a deductible difference, and at the tax rate it is deferred tax asset, debit deferred tax asset, and credit income tax expense. In this instance, the difference is 300 and 30% of that is 150. Debit deferred tax asset 150 and credit income tax expense 150. So we know that when we debit or credit the tax amount, deferred tax liability, we credit deferred tax liability, we debit income tax expense, we debit deferred tax asset, we credit income tax expense. So it is the income tax expense that gets changed, never the income tax payable. It is an actual amount that does not get changed. The temporary difference influences the income tax expense, but it does not influence the actual tax payment. We're now going to look at tax differences arising from revaluation. If there's an asset that is for tax purposes and accounting purposes that depreciated at the same amount, then the carrying value and the tax base are equal, and as a result the depreciation expense and the deductible depreciation expense also becomes equal. There's no temporary difference. But if the asset is revalued, then we are changing the carrying value of the asset. When carrying value of the asset is changed, then carrying value will not equal the tax base. As a result of that difference, it will give rise to a taxation impact because the difference will result in a temporary tax difference. Here is an example. In this example, the first section, top section, shows the accounting depreciation, and the bottom section shows the tax depreciation. And taking them as same, there's no taxable temporary difference because the carrying value equals the tax base. Let's say that we are now revaluing the asset on 1st of July 2030, 175 to 90. By doing that, we're increasing the carrying value. And after revision, we're going to depreciate the asset. The new revised or the revised carrying value over the remaining useful life. And the tax office will not consider that revaluation but continue to depreciate the asset as it is. And it is the full life is 4 years. So if you look at this depreciation, we can see that the carrying value and the tax base at the time of revaluation gives rise to a difference. Carrying value is greater than the tax base. So there's a taxable difference, and the tax component of that is deferred tax liability of 4.5. So we credit deferred tax liability of 4.5. Generally, we adjust this as a debit to income tax expense. But in the situation of revaluation, we debit the revaluation surplus rather than income tax expense of 4.5. Deferred tax liability balance will now keep changing from 1st of July 2013, beginning of the year, 30th of June 2014, 30th of June 2015, and 30th of June 2016. We can see that the temporary difference keeps changing, but that temporary difference decreases over the years, and finally, when asset is fully depreciated, carrying value becomes equal to tax base, which is zero. The tax liability balance will also decrease, ultimately becomes zero. What it does is we start with a deferred tax liability of 4.5, and then it decreases to 3, 1.5, and 0. So our journal entries are such that we credit 4.5, and then in the next year, we need to bring that back to 3. So we debit deferred tax liability 1.5, and in the following year, 1.5 debit, and in the following year, 1.5 debit. So you can see in the last line, on the bottom line, deferred tax liability of credit 4.5 gets offset by the debits, the three debits of 1.5, and therefore the net effect of the deferred tax liability becomes zero across time. Therefore, it is a temporary difference. That difference gets reversed and nothing at last is left. When we want to make journal entries, if it is revaluation, first thing is we need to, under the net method, we need to reverse accumulated depreciation into planned costs and then revalue the asset with a revaluation surplus plant 15 and revaluation surplus 15, and then we recognize the deferred tax liability, and that deferred tax liability is 4.5, that is on the 15, and we credit deferred tax liability. We debit not income tax expense, but the revaluation surplus 4.5. So if we show these journal entries, I said to you that deferred tax liability gets reduced in the following years. When it reduces, we debit deferred tax liability. And that debit of deferred tax liability, when we reverse it into income tax expense. The reason we reverse to income tax expense and not revaluation surplus is because over time, that increasing asset value, the revaluation, will generate more income for the organization because it's an asset. It generates more income, and that more income is now is offset by the income tax expense. So that deferred tax liability, the tax liability, which is the obligation to pay taxes, obligation to pay taxes is now reversed because that obligation to pay taxes decreases. What we should pay decreases over time. Why we debit revaluation surplus, not income tax expense, when asset is revalued? Because one is revaluation is an entry done on the balance sheet. The future cash flows arising from revaluation does not become realized immediately, and revaluation is unrealized earnings. And all unrealized earnings shown on balance sheet are shown after tax. Therefore, we remove the tax component, which is the conceptual income tax expense, income taxes, but rather than debiting income tax expense, we debit revaluation surplus to make it after tax. So we can show the accounting entries after the asset is revalued. The depreciation expense becomes 30, accumulated depreciation is 30, and the deferred taxes arising from that is for that period is deferred tax liability is 1.5. That's the reversal of deferred tax liability, and we credit income tax expense of 1.5. So why does temporary tax gets reversed over time because deferred tax liability value was for the asset that at the time of revaluation, and assets loses its value over time, and that loss in value in an asset is becomes a depreciation expense that leads to decrease in accounting profits and decrease income tax expenses. So if we show it schematically at the time of revaluation, we debit asset and credit revaluation surplus. And the tax impact of that, we credit deferred tax liability and debit revaluation surplus. In the following years, for the difference, we debit deferred tax liability and credit income tax expenses until the deferred tax liability completely reversed. Well, once it is reversed, we still have the deferred tax or the deferred taxes, the other side of deferred taxes on the revaluation supplies, which is 4.5, we debited. And when the revaluation surplus account is closed up, the asset is fully depreciated or sold out, we credit the revaluation surplus to take out that revaluation, and we debit retained earnings where the earnings are now decreased because the revaluation surplus or the reserve is now transferred to earnings because the revaluation is realized either by sale or by the use of the asset. And the revaluation surplus arising due to asset revaluation, which is 15, also gets reversed because it's a reserve. It gets transferred to retained earnings. That 15 gets transferred to retained earnings. The second aspect that I want to talk about was the temporary tax differences arising from accounting losses. If taxable income leads to income tax payable, then loss should lead to income tax not payable or the tax loss. The Australian Taxation Office offers incentive for businesses that the losses or the tax loss can be deducted from future income tax payable. So if there are tax losses incurred, they can be carried forward, and when an organization makes profit and income taxes have to be payable, those losses can be offset against income tax payable. So income tax loss is like a deferred tax asset. It has value, and because it can provide tax savings in the future. So if we take an example where there are tax losses in 2 years, 2 consecutive years, 300,000 and 400,000, and then in the next year makes in the year it incurred a 500,000 loss. It is expected 500,000 loss, and in 2013 and 14 it makes profit of 300,000 and 400,000. How do we deal with this situation? And in the 2012 we credit income tax expense for the accounting loss, which is 150,000, and we debit deferred tax asset. And 2013, we do the same thing. We 2013, when the company makes profit of 300,000, we reverse part of this loss, and that's 90,000 on the 300,000. So we use up the loss against income tax payable. So we credit deferred tax asset and debit income tax expense. In 2014, we use the remaining deferred tax asset, and we credit deferred tax asset and debit income tax expense. And once we have completely used up the deferred tax asset that arose from the tax loss, and anything else becomes payable, and we credit income tax payable and debit income tax expense. So the income tax expense here includes the reversal of deferred tax asset and the income tax payable that's shown in the third or the most bottom journal entry. So what we have in a situation where we recognize a tax loss is we credit income tax expense and we debit deferred tax asset. And when we use a loss, we credit deferred tax asset and debit income tax expense. And once the loss is completely used up, we credit income tax payable and debit income tax expense. The third aspect is the temporary tax differences arising from income tax rate changes. When the income tax rate changes, the deferred tax values keeps changing, and they have to be revised. Any change in those values becomes immediately realized as income tax expense, either a debit or a credit. It increases or decreases income tax expense. So in this example, that there's deferred tax asset and deferred tax liability that's recorded in the company, and the tax rate is being changed from 30% to 25%. That means we have to now restate deferred tax asset and deferred tax liability. The restated amounts would be lower. Now to restate these amounts, we first cross it up. The 400,000 we divide by 30%. That's the original tax rate, and we find the deductible difference, and then on that deductible difference calculate the tax amount. So the reduction in deferred tax asset is from 400,000 to 333,333. The reduction of 66,667 becomes a credit or decrease in deferred tax asset, and that decrease becomes included or debited into income tax expense. Deferred tax liability, we do the same thing. We take the tax liability and divide by 30% to find out the taxable difference, and that is 666,666. And then we find the revised deferred tax liability, and that's 166,667. We find that there's a reduction in deferred tax liability of 33,333. That reduction in deferred tax liability, we debit deferred tax liability, and then we credit income tax expense of 33,333. But that 33,333.5 that's shown in income tax expense is the net value that results from the change in deferred tax liability and deferred tax asset. So this shows how the profit before income tax expense becomes taxable income, and the profit before income tax expense is at the tax rate gives income tax expense, and taxable income at the tax rate gives income tax payable. So the income tax expense and income tax payable are not equal because there are differences, temporary differences, and those temporary differences as gross amounts can be deductible difference or taxable difference, and that difference are the ones at the tax rate become deductible difference, a deferred tax asset, a taxable difference, a deferred tax liability. So I'll play a video now. I want you to think about why does lower rate tax rate has an adverse effect on this video is the Citigroup earnings. So I'll play this video now.
To be our client's trusted partner. As one of the world's leading global financial groups, MUFG is constantly evolving and taking on new challenges to respond to the diverse needs of our clients. Our group of 150,000 employees and reliable network of offices demonstrate the highest levels of professionalism. Your trust, your future, our commitment. MUFG.
To 17 of that for revaluation of their deferred tax asset, around 3 to 4 billion in terms of taking a hit to the balance sheet because of the reason I think it's grabbed a few headlines is that at the best they only invested this based on a 25% tax rate. If that was what achieved, they gave some forecasts then in terms of what hit they'd have to take one time to their capital. This 20% rate is the 5% difference is having a bigger effect than people had expected. So this sort of one-time revaluation of the deferred tax asset is accounting for most of the 20 billion, 16 to 17 of it, 3 to 4 because of repatriation, and that's why you're seeing Citi down more than the others in terms of that one-time effect. I mean, all of the CFOs, all of the CEOs we've heard over the last 2 days at the Goldman Sachs conference have addressed how you'll have a few tweaks to things like that on the balance sheet if they've got deferred tax assets. Citi always had the biggest of those. But in general, moving forward, they're all pretty positive about the effects it will have in terms of their ability to keep more earnings from each year's individual earnings moving forward. Clearly, the average tax rate in 2016 for most of these big six banks was close to 30%. So they will be getting a positive effect for their earnings moving forward. Could be at a negative effect here to Citi in terms of their deferred tax asset.
Mike, the other thing that's, kind of interesting, maybe funny about this is if they're going to get hit that much from the change in the tax rate, it shows you how big that deferred tax asset still is.
Exactly. And it potentially was never fully going to be realized, the value of that. It's not just going to be the banks. There are lots of companies, mostly on the smaller end, that do have big tax loss carry forwards that have been reduced in their tax. So you're going to see a lot of this kind of cinching up of the numbers once this all comes through. And I think on the repatriation side, if the bills go through as written right now, it's not just, if we decide to do something with the cash, we'll owe taxes on it.
No,
it is, you owe us that much tax right up front, whether you do anything with it or not.
Absolutely. And Wilf, by the way, I don't know if you have anything else to add on the high teens guidance they've given on the declines in trading revenue for the fourth quarter, which sounds like it is a little bit worse maybe than JPM and Bank of America.
Yeah, really only fractionally worse. I don't think that's moving things as much. I think Marianne Lake yesterday said down around 15%. And again, I think we were forecasting around that area. Trading revenues clearly haven't been an area of strength over the course of the last couple of quarters. I mean, the interesting move over the last couple of days, including yesterday's Wells Fargo, which is the outperformer in terms of the headlines from these two conferences. And that was really because Tim Sloan suggested for the first time in a while that he was willing to commit to set targets for cost cuts moving forward, which they haven't done recently, and the other banks have done successfully. He was also a bit more upbeat in terms of corporate loan growth, which is an area they suffered on last quarter. So Wells Fargo, the outperformer.
Why does the lower tax rate has an adverse effect on Citibank or Citigroup earnings?